you from their lenses, and we brought in alums from from various perspectives to help us all collectively figure out what's going on and what's next. So with that, I'm going to start off, go around our panelists, and we'll start off with Professor Atif Mia, who's joining us live from New Jersey. So Atif, over to you.
Thanks, Julia, and thank you all for coming. I thought today, since it's also a day, we are talking about racial diversity and sort of the lack of convergence really in the racial gap in the U.S. I thought I'll touch upon this question of not just the racial wealth inequality, but also some of the deeper fractures that have been developing in the U.S. Economy over the past few decades. It's a point that I've emphasized in our previous calls as well. But today I'll just talk with reference to wealth inequality and what that means and how to kind of conceptually think of wealth inequality. So first of all, as everyone knows, wealth inequality, just in terms of the levels of wealth inequality, is very high in the US. But what I want to focus on are the gaps in the levels of wealth across different subpopulations in the US. So in particular, if you start off with the black-white wealth gap, the two things that are very sort of that stand out is that not only is that gap very large, so it's like anywhere from 6 to 7 times as high is the wealth of the average white as opposed to the average black family in the US, which is extremely large difference for large subpopulations in any given country. But really, perhaps even the more troubling situation is that wealth gap has not narrowed at all over the last 4 to 5 decades. And so this really points out to structural problems with the economy or the wider society, if you like. So that's sort of the one thing that I want to focus on. One way to think of this wealth inequality is to first look at the broader growth in wealth in the US economy. And one measure that I particularly like to think of is to think of not just wealth or the aggregate dollars of wealth, but to think of wealth in terms of wealth to income ratio. Okay, so imagine whatever, someone earning $100,000 a year, how much wealth do they typically have? So that's the ratio I want you to think of. Why is that ratio useful? Because in a way, whatever we call wealth, it's actually some capitalization of our income stream in the future, one way or the other, either the income stream that we might have or the income stream that we might earn from the assets that we own. Think of stocks like dividends, or think of rent if you're owning a house, and so on. So wealth to income ratio is a useful measure to sort of track how much income that you're earning today you're able to capitalize as your holding of overall wealth. And if you look at that wealth to income ratio, the thing that strikes out is that the wealth to income ratio for the US as a whole has risen quite a bit over the last 20-30 years. So it has risen by something the order of 200 percentage points, if you like, this wealth to income ratio. So for the same level of income, the US in a sense is a lot wealthier. Just take that as one basic fact. However, the other important fact is, and this is another way of thinking about wealth gaps, whether racial or across class lines, is that entire increase in wealth to income ratio, it's all driven by the top 10 and actually the top 1%, to be more precise, actually. To put it differently, if you look at the bottom 90% of the US distribution, they have not seen any increase in their wealth to income ratio. So what does that mean? That means two things. Number one, we already know that income inequality has risen in the US. So this bottom 90% has already been losing share of income of the overall pie. But something else has also happened, which has made the wealth inequality even worse. Not only have they lost income, but for the dollar of income that they have been able to keep to themselves, its capitalization into wealth has not increased at all. When for the overall, for the US, which is again entirely driven by the top 10% or more so for the top 1%, the capitalization of income into wealth has really increased tremendously. So that these two forces, the concentration of income across the population, and then the capitalization of that income into fewer and fewer hands, that has really snowballed into this what is really kind of this hyper level of inequality when we talk about wealth. And that is now showing up in ways that we have really never seen before. So I just talked about the black-white wealth gap, but obviously, as I've already kind of explained, this also exists now structurally at a deeper level. So even within whites, for example, if you take the top 10% versus 90%, you'll see these persistent gaps. And one other way in which this shows up is now across the age distribution as well. So one other very interesting manifestation of this, again, this polarization in wealth, is that I sometimes kind of say it is like the old are eating the young. That is to say, this rise in wealth, and especially wealth to income ratio, it's actually all concentrated among the older cohorts. And perhaps those of you in California can relate to it even better. Whatever assets you ended up having in the 70s, 80s, or early 90s, they have really grown in value. So whoever owned them, and those people on average are much older. Think of those who bought houses when they were really cheap in California. They are really the ones that have benefited a lot from this rising wealth in the US, and everyone else feels kind of left behind. Perhaps the most troubling aspect of this is that it's the younger population that feels left behind, and more so if you are younger and you belong to kind of the disadvantaged community, whether those are Hispanics or the Blacks and so on. So that is a very important kind of societal fracture to worry about going forward. The last thing I want to emphasize, and this is sort of a deeper economic point, but it's really important, I feel, especially if you think of what the Federal Reserve is doing these days and so on. One of the reasons this has happened is that the economic system that we have, the way it tries to respond to economic weakness is it tries to respond to that by lowering the interest rate. And remember, if you go back to our earlier Zooms, I said at one point before that if you want one sufficient statistic, just focus on the 10-year treasury. And if that one is not going up, things are still bad. One of the reasons I mentioned that is because the way the economy responds to economic weakness is it tries to lower the interest rate to try to juice the economy up. Okay, be as it may, whatever its consequences are, on the wealth side, it has one important implication that feeds into everything that I've said, which is when long-term interest rates decline, the people who benefit the most are those who already own long-term assets. So if you own housing, if you own long-term bonds and so on, you become richer right away. When Fed lowers rates, through forward guidance, it lowers future rates as well. Many other things happen, but on the wealth side, one consequence is that people who already own assets, they become even richer. So this actually has been one important force that has kind of, snowballed on top of the other structural imbalances that the economy has, and sort of loading up on the same interest rate margin by trying to keep it lower and lower to juice the economy. Not only is it not going to be as effective, but it's also going to further exaggerate the wealth differences that we have in the economy. So I think, the wealth problem, the wealth disparity problem is much deeper, and it's a core structural problem that the US faces at this point. So I'll just end on that.
Yeah, no, and I think it goes even beyond that, right? Because that imbalance, I mean, we see that, in the last 100 days, our kids have been learning from home, and they have, tablets, and they have computers, and they have stable internet connections, and an environment where they can learn and continue to learn from home. Are, the folks from, more, less privileged neighborhoods, they don't have the computers, they don't have their individual devices, they don't have the internet connection, or the teachers aren't willing to go out and teach.
So that's a great point. Let me just quickly mention one study. So I don't know if people are familiar with this kind of this Khan Academy style learning tool. Is called Zern, like just learn, but starting with a Z, Zern. A lot of schools and kids use this. So some academics, they did this study. So they followed, the performance of kids using Zern before the pandemic, but then post-pandemic as well. And they have this graph that is really striking. What the graph basically shows is exactly as Shuja said, if you are in the upper income bracket, you were doing well on this earning stars and so on, and you continue to do well post-pandemic. But really, other kids who were doing equally well before, they start dropping off the cliff. You can literally see that in their scores and how many stars they are getting now and so on. And who are those kids? That's exactly what you would expect. They are, who not as well off, they are more impacted by the pandemic crisis. They don't have as much help at home and so on. And you can see that gap in educational attainment, just, it's really striking the level of that gap that wasn't there before, but now open up. So again, this pandemic is just cutting us at exactly those pain points that we were already hurting at. And so it's making those fractures even more salient.
Yep. And happening at a stage in life when they're developing strong foundations for learning, right? So
Shuja, can I ask a question from Atif, if you don't mind? Yeah. So maybe relating to this and leaving sort of the politics out of this, in terms of economics, could we as a country afford a universal basic income or a universal healthcare? Meaning, if you just did the dollars and cents and leave the politics out of it, and kind of, would that be? I was sort of convinced at the beginning of the pandemic that we would get some form of universal healthcare and some form of universal basic income in some other name, maybe, like because you need to have healthcare testing for everybody, you need to support people through like these unemployment type programs, right? But you would call them something different, but essentially it would yield universal coverage of both health and some income.
So let me
what do you think about that? Yeah.
So let me take the healthcare question first, because that's sort of the easier one. The healthcare, the US can certainly afford it. But it is important, it's important how you deliver healthcare as well. What I mean by that is that it is important how efficiently you deliver healthcare. So the first order statistic we need to know about healthcare is that the US far outspends its peer countries, like, think Canada, think European countries as rich as the US or close to it. It outspends those countries in healthcare in terms of the what we get out of it. So, US has the lowest life expectancy for sort of a very high level of health expenditure that we are already putting in. What that tells us is that our health expenditure is extremely inefficient. So I think there's a lot of room in the healthcare. So that's why it's a longer, kind of a more complicated discussion. But if your question is just can we afford it? The basic answer is yes, absolutely. We can afford it. You have to kind of restructure the health system in some ways and so on. And it's like it's really kind of in a stupid way, I would say, almost structured, and so that needs to be changed. But yes, of course, we can afford it. The basic income, universal basic income, is a more delicate question in terms of affordability and so on. If you run the basic raw numbers, they turn out to be very large. And if you're interested in that, there's a MIT economist, actually, Daron Acemoglu, one of the sharpest minds in the business. He has an op-ed, you can kind of Google for it, where he sort of runs those basic numbers and he says, look, people don't understand, it is extremely expensive, so it's not easy to pay for this and so on. I think the better way to think of the universal basic income is in terms of social safety nets, and so giving protection to those to make sure that they don't fall below a certain level. And really, perhaps the most importantly, to bring it back to the conversation that Shuja was having, is equality of opportunity for everyone who is born in the US or lives in the US. And that really comes back to providing equality of opportunity at the schooling level in terms of educational attainment and so on. So that, for example, universal pre-K, that's something the US can definitely provide, right? So I think I find it better to think first in terms of providing equality of services, including healthcare, pre-K, quality of education. And I think those are the margins which need to be equalized first. And then at some point, one can think more carefully about basic income, but the universal basic income, the numbers run up very high very quickly.
And Atif, I have a quick question. When you talked about the inequality, it's interesting if you look at also the divergence in various states, right? Because sitting here in the Bay Area, it feels like, yes, you see some businesses, small businesses being impacted, but you'd assume there's a higher percentage of that 1% in certain areas of the country as well. And do you think the impact of this pandemic exacerbating issues is going to also vary dramatically by states and disadvantage certain states so much more than other states going forward?
No, I think, yeah, absolutely. I mean, one of the things about this inequality and rising inequality is that it's very much fractal in nature, which is no matter how you cut it, you see people diverging. So if you look at states are diverging. If you look at cities are diverging. There are the haves and the have-nots among cities. And then when you cut it within cities, you see within cities, populations are diverging. You have sort of ghettos forming within cities, and then the rich are kind of pulling away from the rest. So it's really a phenomena that you are seeing at sort of multiple margins. As I said, fractal is the term that comes to mind when thinking about this, and that shows itself ultimately in the politics as well. So when we talk about polarization, I think there is an economic reason for that polarization and the politics as well, which is that the economics has become very unequal. But it manifests itself differently, right? So maybe the whites who are feeling left behind, they might react politically very different to someone of a darker complexion who also feels left behind or not doing as well. So I think the way people show anger is not necessarily on the same platform. So you would imagine that is the poor, they come together and they fight, which probably would have been a better situation if that's how the politics turned out. But one consequence of this fractal inequality is that the politics has become very polarized, because basically the politicians can kind of appeal to that discontent, but they can appeal to it in very different ways, sometimes hateful ways, which are obviously something we have seen very clearly in the US and beyond. So this really is kind of the issue of our times. And it is showing up everywhere. It's society, politics, as well as the economy. Since I'm an economist, I usually just take the economics angle first, because that's something I feel I can say something more about. But it is really something that transcends us all. The last thing I'll say is I think what is important is for us to, whether we are in the top 1% or outside of it, is to really understand that this is an issue that is going to impact us all. It might not be impacting us now, but it's going to impact our children and so on. So it is something, whether we feel the pain as much as the others, but it is an issue that really needs to be brought to the forefront. And to some extent, all of us will need to make some sacrifices. And that requires taxation of different sorts, but also redesigning some of our social security systems and safety nets.
So on that note, I'm going to sort of move the conversation forward a little bit, and we're going to come back to sort of what can we do, and if there are any creative solutions around it later on in the discussion. So next, I'd like to invite Sujay to sort of share his thoughts.
Sure, and I think this is a very good segue, actually. And Pegah, I'm glad you asked that question, particularly about states that may or may not be disproportionately impacted, and that's certainly the case as we look at where we are in the pandemic now. 2.25 million cases across the U.S., 120,000 deaths. But if we look at the rates of increase versus stable versus decrease, there is a huge disparity in where that's occurring. The states, there are about half the states in the U.S., 23 of them, have increasing numbers, and as we talked about last week, that is despite the fact that some increased testing capacity may explain some of that. It doesn't explain all of that. And if we look at those states, Alabama, Arizona, even California, South Carolina, et cetera, a lot of these are the southernmost states. And if we zoom in and look at who is disproportionately getting affected in those states by infections, this so-called second wave, which is not the true second wave, that occurs in the fall, but this sort of uptick in cases is very disproportionately affecting those states that have a very different demographic, and a demographic, unfortunately, that has shifted toward exactly the kinds of populations that Atif mentioned. 8 states are stable, though many of those are the Midwest states, so Indiana, Missouri, et cetera. And then 18 states are actually showing declines, including Colorado, Connecticut, Massachusetts, many of the other eastern seaboard states. So that is a very clear disparity in where cases are increasing, stable, and decreasing, and it very much overlaps the other divides that we see economically and socioeconomically in this country. I did want to share some slides that I had made about some of the disparities that have really struck me in our area, Northern California, and specifically, it may lend itself to a conversation about creative solutions, Shuja, as you mentioned. So let me just pull up my PowerPoint, and if we can see this here, can you see that okay?
Yeah, you may want to just put, yeah, looks good.
Great. So first, I plotted out what's happening actually in the county of Santa Clara, where you can see that we had our peaks somewhere in early to mid-April, and then we started seeing a very slow decline since that time. But in early June, we actually started seeing what is probably a sustained uptick in cases. This is, again, in our county, and this is reflective of a lot of what's going on in the southernmost parts of our county, San Jose, even East Palo Alto. And as we advance, one thing that was very interesting as we studied many of these cases that got admitted to Regional Medical Center in San Jose was that one striking thing is that over half of them had no exposure that they could tell you about as to how they may have gotten infected. As you can see, it's racially very biased toward Hispanic and Latino populations relative to what we see in the county populations. But again, what was very striking to me is that people can't tell you how they might have gotten exposed. They didn't think they were traveling. They didn't think they were really going anywhere that was worrisome. And then if we look at the employment of many of these individuals, some of the demographics and imbalances really become clear there. We anticipated some of this, but it's very different to see these individuals in the hospital in person, where you ask them what do they do, and they're either in construction, food services, factory, etc. It's not as if 12% of our population works in construction, but 12% of the patients that we are seeing in construction are getting infected, are part of this uptick in cases. And that just reflects a lot of what's happening in our area, particularly in the areas where the demographics are quite skewed. And as you can see, uninsured or Medi-Cal status is almost 2/3 of individuals admitted to that hospital. And the final thing that I wanted to bring up was where these cases are coming from. And on the left, these are the zip codes of the individuals that are being admitted to Regional Medical Center, again, more of a county hospital in San Jose. And if you look over to the right, the top right shows you the population density in these areas. And you can see the densest areas where individuals are probably sharing apartments and multi-individual households. Those are the areas where people are coming from in this new uptick of cases. And as you can see in the lower right, these are also the places where the median incomes are much lower. So although we certainly know of these things, and it's not surprising to anyone, it certainly drove home the point for me when I mapped out exactly where these cases are coming from, and overlapping on top of that, what is happening demographically. And it's beyond just a healthcare issue, obviously, but the issue of population density, I think, is one topic that could lend itself to creative solutions. The issues of income equity that we've been discussing before are other issues as well as how to maybe target some refined or maybe enhanced interventions in these communities, understanding that they may not even realize where they got infection, and it may just be the household, it may be asymptomatic people. I'll close on a question that I get a lot, and we talked about last week, and probably, and maybe I'll answer an interesting question that Pega brought up a little earlier today as well, on mask effectiveness. And I know that many studies have now been forthcoming in the literature regarding mask use and modeling what could happen if we use masks. And what I really want to draw your attention to is this box here, where, and what this shows is people who are wearing masks only if they develop symptoms, after they develop symptoms, or people who wear masks all the time, implying that they are protecting themselves and others before they develop symptoms in this asymptomatic period where they could transmit. And as you can see, somewhere in that sweet spot is about 50 to 75%, and other studies have shown about 60%. So 60% of the population wore masks that were about 60% effective. We would drive the reproductive number, or the R0, or the transmissibility of the virus, down below 1, which is this dotted line. If you drive it below 1, the pandemic burns out. And so the idea that we should universally mask is really something that isn't just made up. And I was driving along the 101 today, and at first saw a number of billboards, all the billboards on the 101 highway now of people who are wearing masks. And although in a way it's glamorized, I'm actually happy for that, because masks are effective. And if people are able to make them more attractive or make them more socially acceptable to wear, we can show by study after study after study that they are probably the single most effective intervention, aside from distancing, that can actually help us as the US reopens. And Pega asked earlier, and I'm sure others are wondering as well, can we start traveling again? And is that as bad as just going to the grocery store, a number of times, getting exposed over and over? And Pega, I wish I had a better answer for you that was more satisfying, but and would allow us to feel like travel somewhere over and over. But in my personal opinion, that's still not the case, because the transmission is kind of an exponential transmission based on distance. So if you're 6 feet away, then the likelihood of transmitting is low, but it increases exponentially as you get closer. So if you're sitting on a plane, I do think that airlines, et cetera, are taking a lot of steps. So I must admit, I haven't been in an airport recently or on a plane. And I do know that there are very aggressive measures, including cleaning, recirculating the air, and even airports are distancing as well. So there are a number of caveats to travel. But to me, imagining that you're sitting next to someone or near someone on a plane who may be asymptomatic or pre-symptomatic, or may even be symptomatic and is just flying somewhere, and they're close to you, is probably a very different risk of transmission than going through the grocery store multiple times at a distance. It's just a very different risk scenario. So again, I wanted to bring home the point of masks and certainly drive home the point about how the disparities are everywhere, even in our area in Northern California.
You mentioned the R factor, which I've read in a number of places, and I'm fascinated because I have a spouse that's from Germany, and if you talk to anyone there, they know what their R factor is. Like, the people know it, it's in the news. I wonder why that doesn't get talked about here, because they know, okay, we're at 0.77, 0.8. Is it just because of the lack of testing, or is it just that's not a focus of the population, or us here to focus on that number?
Yeah, it's a good question. Maybe interestingly, or maybe even sadly, I think the best explanation of R naught is in the movie Contagion, and there are many other parallels in that movie, I think, that were spot on. I mean, the hoarding behavior and that sort of thing, although medically it maybe wasn't quite as accurate, but the explanation of R naught in that movie is stellar. And I think early on, especially in the conversations involving and press conferences regarding the White House, when Tony Fauci and others were explaining pandemic curves, they did try to bring up the issue of R naught in several conversations. And it may be that now people understand it and are past that understanding or conversation, or maybe we're not as obsessed with that number in this country, or maybe we're not as numerically driven, because to accept that number of 2 or 3 implies that if you are infected, you potentially have the ability to infect 3 people around you, and that it may not be as consistent or gel very well with our desired behaviors in this country, especially at a time where we went through a lot of pain with shutting down the country and the desire to reopen. There probably may be different reasons psychologically in those countries that may have better resources for individuals to stay home and distance, and there may be childcare resources that are available to them that aren't available in this country, that really made people feel very hard hit and just wanted to get back to work and want to ignore things like the R naught. So it's an interesting question, but again, R naught, we won't know until the pandemic is over, after we've analyzed all the data and we understand truly. So our best guesses are that it's between 2 and 3, where influenza is above 1 and measles is something like 12. So we sort of know it's in this sweet spot. And I think that's about right. I think the number is about right, that based on the numbers of infections that we're seeing, it probably is in that range, and that probably is the number of individuals. When I look at households where families were affected, there will be 6 people in that household. maybe 5 of them or 4 of them will come in with the infection. The other 2 didn't even notice anything. And so it is an interesting phenomenon, and I think different countries just approach it in different ways.
Oh. So today there were somebody had requested your slides, if you were able to share that. So I'm not sure if there's a Google slide you could sort of share, or you're comfortable sharing or not.
After our talk, sure.
Yeah, awesome.
Yeah, absolutely.
Well, thank you. So I think I think we talk about, like, Rohini, if you could sort of share your perspective, what's going on.
Sure. And those were both very interesting. Thank you, Sudhib, and Atif for that. So my corner of the world, so as I mentioned, I'm a venture investor, and we're sort of tracking a whole bunch of things in the private markets. Maybe one of the stories, that has gotten some traction in the past couple of weeks is, people are starting to think about IPOs again, which is, in the context of this conversation, the other end of the spectrum. But people do work very, very hard, and an IPO is a milestone for a lot of these companies. And so, we're now about 12 weeks in. I think initially most people just decided that to put all plans on hold, and most companies that announced their first quarter did not give any guidance going forward. The past couple of weeks, people have started talking about IPOs again. So Airbnb, for example, which raised $1 billion at the beginning of the crisis, they just said they haven't ruled out an IPO this year. So people had thought that the $1 billion meant that an IPO was out of the question this year, but they've not ruled it out. There was a PE company called ZoomInfo, which is it's not a household name, but it's basically like a LinkedIn-esque thing of the old world. They went IPO and they had a good showing. And in terms of consumer brands, things that we now expect, and now it's become more normalized. So Instacart, DoorDash, Postmates, they're all lining up. They're all in some form or fashion in the IPO lineup, as well as Robinhood. Robinhood has, talking about the young and the old, it's become the choice financial trading app for young people. And so the demographics have split very nicely. And even though they have had some issues with their own site performance and so on, the company is just very, very popular, and they may be in the lineup for an IPO. And on the enterprise side, we're tracking, the biggest one is a company called Snowflake, which is taps into the cloud trend. It's a data warehouse in the cloud. It's supposed to be a monster IPO. It will be like most people haven't heard of Snowflake. They've heard of Airbnb, but they'll probably be about the same size. So it's kind of interesting. And a company called Asana, which is a project management tool, and it's actually it's an interesting company. It was one of the co-founders of Facebook who started this, and he's separately from Asana, he's also very much into giving and has a very significant philanthropic interest and so on. So there are all these interesting companies and interesting stories that are lining up for IPO. So that was a big development. And maybe the other point that I will make and then pass it back to you, Shuja, is we talked about Black founders, Black VCs, and so what are we doing as a venture community to encourage more Black founders? It's of course, today's Juneteenth. We're continuing the conversation about that. The numbers are still very, very small. So I'll put in the chat box, I will put there's a new website if you want to take up on an offer of office hours. There are about 70 VCs who have offered time, and it's a set of office hours that are available through a calendar. It's a Calendly calendar. So you could go to, it's called vcopendoor.com. You could go in there and request office hours, and I have signed up for 2 hours a week for the next year. So that's kind of how they requested us to do it. So that was one. The other one, which was also kind of interesting, is that a group of 6 companies, which are all very marketing savvy, data oriented companies, they came up with a packaged offer to do free software. So it's M-particle, amplitude, branch, radar, right? So if people are interested in kind of a social justice hackathon, or like, something that's more oriented towards using technology to solve some of these problems, I think it's actually a pretty cool offer. So I will put the link for that in the chat box as well. So it feels good to not just voice support and feel helpless after that. So it feels good to be doing a couple of things, and if people are interested and want to support the action, would love to talk more about that.
Yeah, I think talking about the social justice hackathon, I think 3 days ago, I think we had our session, and one of the things which came out of that was to perhaps organize a hackathon around recruiting to address the lack of diversity. So I think a couple of sort of club members are potentially putting something together, and so you may hear a little bit about that. So I think Maisha and Wendy are trying to put something together on that front. So
yeah, the other thing I guess also striking to me to add is, look, as MIT alums, maybe we can also be demanding more of our schools, because the problem of, look, females have been underrepresented in VC and in tech companies and all that stuff. And yes, the numbers were also low there, but from an education standpoint, it wasn't as disparate as African American and and white population in the higher education system. So I do think we have to make sure that we're also giving advantages in a lot of the private schools and expensive post high school degrees, to make sure that we also are demanding more of that from our education systems.
Right. So that'll be the second part of the discussion today. So where if you have creative ideas, bring that to the table around that, Pega. So I think just following up, and sort of, Rohini, you give a really interesting perspective on what's happening with sort of the private side of the markets, and how a lot of them are now sort of looking for public exits. I know, at least from our vantage point, at least at work, a few of our portfolio companies are certainly pursuing down that path. But we've got a couple of folks who are actively sort of in the thick of those markets and here from New York. So Kashif, if you would like to sort of comment some of there, and then I'll pass the baton to Abid after that. So.
Sure, I'd be happy to. And thank you again for having me. And sorry I wasn't able to join last week's session. So the first thing I'd make a comment on is, and before I start, as is obvious, I'm making my comments in a personal capacity as an MIT alum for this audience, and not representative of my employer's broader market views. But the question has come up a lot in the press and in conversations in recent weeks as to why is the market doing so well in an environment with such high unemployment and the pandemic continuing, and frankly showing signs of picking up in some geographies, as was talked about a little earlier. And when I think about what's driving the market, particularly the equity markets right now, I think first and foremost is the progress of the virus and the pandemic. And the market effectively is looking for signs of inflection, and in general has been encouraged by the data in the past few months, with a fair bit of moderation of that, particularly in the South and Southwest states over the last week or two. But the virus is the primary thing that is driving the markets, because the virus is what leads to the potential for a full reopening or not of the economy. The next thing that's very important is the state of the consumer and unemployment. And this ties into a lot of other things, but while we have very high unemployment, we are also in the midst of a kind of experiment with not UBI, but a lesser form of that right now in the US, which is that the stimulus that was provided by Congress, particularly the $600 a week addition to unemployment insurance, is a pretty substantial amount for the affected demographics. And it started to show up in the macro data in this form that you've gone through this couple of month period where unemployment is obviously skyrocketed. Business activity is shut down, at least it was earlier, but personal income actually increased. And personal income increased in an environment where no one had anything to spend money on because everywhere you spend money is kind of closed. So personal savings actually shot up. And a lot of that is transitory, but the fiscal support is, and specifically the part of it that is a little UBI-like in terms of a mini experiment, is a big part of why markets have been potentially outpacing the real economy indicators, particularly the labor market indicators. And the third very important aspect of what's driving markets is the broader stimulus. I mentioned the fiscal, but the role of the Federal Reserve, the role of rate cuts and QE, what all of that has done is drop interest rates, as Atif mentioned earlier, to very low levels. And because on one level, equities are valued theoretically from on a discounted basis, that just inflates equity values in kind of long-term models. But more immediately, what it also does is it shifts assets that were seeking income, call it pension funds, retirees, whatever, that got their money from coupons on bonds, to now seeking to get their money from dividends and free cash flow from equities. So there is a portfolio shift from fixed income to equities, and that is part of the. It's not a side effect. It's part of the plan. It's part of what the Fed wants to do and is deliberately doing to maintain its ultimate objective, which really is to minimize the employment hits. When we look at what they do to credit markets, why are they effectively making it? What they've done is they've removed liquidity risk for corporate bonds by acting as a backstop and starting a corporate bond purchase program, which is really the first time in the United States that private assets are being bought by a government entity. What they've done is make refinancing easier for companies. And what that does is it solves companies' liquidity problem. It doesn't solve their solvency problem. So if you're in a business, say that involves a lot of social gathering, like restaurants, etc., those remain and will be tough businesses coming out of it. But what they've done is dramatically extend the runway. And in doing so, in their calculus, they are cushioning the employment blow. They're lowering the rates of bankruptcies. So they're trying to prevent a financial crisis being added on top of the pandemic that's already underway. So I'll pause there if you have any follow-up questions.
So, no, I think that's a good overview. I think there are a couple of questions which have come up is from the audience, and I'll just throw that out. So what will happen if the U.S. government doesn't bail out the states who have been spending on social services?
Sure.
You didn't touch on that, but yeah, if you could.
Absolutely. No, I'd be happy to. So I mentioned a few. So when we look at market levels and risk market levels in general, whether it's stock prices or credit spreads, they are embedding some forward-looking beliefs. One of the beliefs that is effectively more or less embedded in stock prices right now is that there will be more fiscal stimulus. So just as the CARES Act was passed and had a price tag of $2 trillion or so, the expectation of the market is that there will be more, probably next month, and that more will involve some extension of unemployment insurance, probably not at the $600 level, but enough so that the unemployed consumer, generally of middle and lower middle income, is not too negatively affected. And in addition, the biggest holes in the economy are the state and local governments that are incurring a lot of extra costs and are losing a lot of revenue, because regardless of the state's financial structure, if you take states that have no income tax, they rely on sales taxes and real estate transaction taxes. Those have come down a lot too. So all states, regardless of political leaning, have been hit pretty hard. And there is a belief embedded in market prices right now, that there is another round of stimulus to come. There is a view that it is something that all political sides will agree on, particularly leading into the fall election. And if that is disappointed, that's a pretty significant negative catalyst for market prices, I think.
Yeah. And I think there was another audience question around that how do you, while the next stimulus package comes in, I think a lot of the small and medium businesses have not benefited largely from these stimuli packages, right? So what can sort of non-government agencies or consortiums or
Sure.
et cetera can
Yeah,
help?
and I think that my answer goes back a little bit to what Atif said, which is that we are in a political economy that has gone in a certain way for a very long time, probably 2 generations now, to where, frankly, the big get bigger, and it's a bit of a top-heavy economy, whether that's related to wealth distribution across the population, or whether it's related to which companies have the opportunity to thrive and grow in adverse environments. And one of the reasons why, particularly like big stock market indices, can be a little bit disconnected is because their composition has changed over time. So, right now, almost 25% is half a dozen very high margin tech companies that are continuing to do very well. And when you go to other big sectors, whether it's in finance or whether it's telecom, they're also very consolidated. So when we think about, so I do think that this will be another environment where the big will get bigger. There was an article, I think just 2 days ago in the New York Times that's worth reading about, it's focused on big tech in particular, but it applies to a few different industries where you can see the big get bigger. Having said all that, government institutions, particularly the Federal Reserve, is very conscious of this. And they're very conscious of the criticism they got after the last crisis for backstopping and bailing out the largest financial institutions through TARP. That was targeted to the largest banks. And so announced a couple months ago, but really just becoming operationalized this past week, is something that is titled the Main Street Lending Program. And it's titled the Main Street Lending Program for that purpose, that they're trying to, even though it covers companies up to, say, 15,000 employees, it deliberately excludes companies that are portfolio companies of private equity. And it's their effort to show that they want to partner with private sector lenders to provide a backstop to support business down the chain. I don't think it'll go all the way down. So smaller neighborhood businesses, restaurants, etc., are going to continue to have very challenging circumstances because they're not well capitalized businesses. But you can see that versus the last crisis, there is a big shift from the Fed with the launch of something called the Main Street Lending Programs, which are just being operationalized now. And interestingly, their effect won't show up for a few months. Just like the PPP got a lot of initial attention, more of it has been dispersed than not, but it's still going to keep running for a few months. So this, the effect of the fiscal stimulus will last for a little while and is supporting consumer spending and it's supporting asset prices.
Got it. So no, thanks, Kashif. Abid, would you like to chime in with your views now?
Well, I guess on which topic, but I guess let me take a few of these which have been discussed already, right? So I think let me kind of start with the first one, which is kind of closest to home from a consumer packaged goods perspective. I think what we're seeing at least is that people were sick and tired of being stuck at home, and I think as restrictions are being lifted, we're definitely seeing consumption patterns change such that people are beginning to consume more out of home, whether it's in C-stores or whether it's going to the local restaurants. So at least we're beginning to see some of that. Not necessarily that I'm not sure if that's a good thing, because I mean, if you think about second wave or other risks associated with that kind of commingling, we don't know what that would mean in a few weeks' time. But clearly, the people were tired of being stuck at home. I think taking my second, kind of putting on my second hat, more from a family office perspective, look, I would echo a lot of the same thoughts that people have said, right? But I think we at least look, we remain somewhat skeptical that the forward-looking market is as prescient as it may seem. You've got a lot of people who are discounting an extremely rosy scenario that may play out, right? And again, there's always the possibility it may play out. But I think if I was a betting man, and I think as investors, you always have to take a probabilistic approach to things, right? You think about what are the possible outcomes and how will I probability weight it, and then figure out, what kind of a bet do I want to take, or position do I want to take? And we're a bit skeptical. I think some of the behavior that we're currently seeing in the marketplace makes you scratch your head. When a bankrupt company like Hertz can, in theory, get very close to doing a $500 million offering, where the actual documentation, the prospectus of that offering was saying, essentially, we are going to zero. And for all intents and purposes, you're giving us money for us to take this money and give it to your to the debtor in possession, basically bankruptcy financing. There is something wrong, right? If the SEC hadn't stepped up when they stepped up, that would have actually gone ahead. So when you see those kinds of dislocations, it's very hard for me to kind of at least believe that we have rationality right now in the market. Again, there's pockets of irrationality and there's pockets of rationality, I'm sure. But even if the average investor out there is thinking through and saying, great, there's another fiscal stimulus coming, there's more free money that will be dropped from the helicopters and everybody will have a lot of money to spend, we still have to think through, where is that money coming from and what are the consequences of that money that's being printed? And is it actually ending up in the most productive areas of the economy and in the hands of the people who need it the most? Bailing out junk bond ETFs, in my opinion, is not helping 25% of the American population that is literally, according to a CNBC survey, are skipping meals because they don't feel food secure. So anyway, that kind of comes back full circle to some of the other points that Atif started out with. And again, look, I think the problem that we have right now is that and this is back to a couple of calls back, we are an extremely divided country right now, right? When wearing a mask or not wearing a mask becomes a political statement, when acknowledgement of racism in this country, despite what we're seeing on the streets and on TV, is a political position, I think we have a problem on our hands. And I think as American citizens, as MIT alums, as hopefully people who have a voice and actually hopefully can empower change, we need to be much more vocal than I think we have been in the past. So anyway, with that, I'll give Peg a chance to chime in as well.
So I think that's a great segue to the next question, Pega, and you'd love you to lead it. It's like, what can we do as MIT alums? As how can we use the men's and manners, the hands and minds, for sort of good, positive change?
Yeah, I mean, I've got all the answers, guys. No, I guess I will say on the economic, look, on the part, if I look back to the financial crisis, and I was in a bank when the financial crisis happened, I just saw a lot of wealth being taken out of really the upper 1%. Yes, people lost their jobs, but there was a lot of wealth that also left that top percentile because of who was in the markets, and the markets took a huge hit right after that, and that people who had homes, so the housing prices took a hit. And when I look at now, I'm like, I don't see the higher end taking as big of a hit, and we're part of that, right? Like we're all in that bucket, and as much as we think things are bad, we're not taking as much of a hit. So to me, both on the social, on the economy part, I feel like we need to also demand more and be okay losing out a little bit more than we are if we're going to also fight for some of these inequalities to happen. Because in the process, we're saying, okay, we're going to either have slightly higher taxes, or we're going to have, demand more of the government spend in certain areas. And if the propping that's happening with the government isn't happening, we'd all be losing more wealth, and maybe the other 25% would go less hungry. But so we have to also realize that it's all not zero sum either. It's not like, hey, everyone's to tackle some of these hard problems. There has to be something we have to give up as well, and really think about that as well, and be okay with it and say, okay, we're at a point where that makes sense. And then from an alumni situation, look, I think for the ones of us that are lucky, that are in corporates that are stable and have, good job security, at least for now, can work from home, I do think we should use the resources of our companies to see how much effort we can do. The companies are very receptive these days on if you come, not necessarily from an activist area, but if you have ideas of, hey, I want to support this area, or I think, there can be more we do here. Companies do have the larger companies have a decent balance sheet, and we talked about the access to capital. I think we should use our positions in those large companies to figure out what we can do both for the MIT community and for our local communities. Not just have the corporate at the top decide here's the stuff we're going to do, but come to ideas. They're very receptive. They are opening their checkbooks to thinking about those things. So let's be proactive and use those resources we have in those large companies. And then secondly, I would say as a alum, look, I mean, with the Black Lives Matter situations that are happening now, I kind of hijacked a part of the conversation earlier, but I do think we as alums have to demand some of it as well. We are supporting, MIT still from either our financially or just supporting from a community standpoint. We should be getting more diverse populations at MIT and evaluating. I've looked up the stats recently of, a while ago about the women ratio, but I have to say, I wasn't very receptive of looking at the ratio, the stats for how many African Americans MIT lets every year. Like, it wasn't something I looked at regularly, right? And so we need to be looking at those things as well so that we're cognizant of it.
Cool, excellent. No, and I think Pegah, to your point, I think you have done. I mean, in a way, like how you leverage your position at Cisco to help support MIT and the club as well, right? So in terms of.
And I haven't done it. I'm actually thinking more ahead of using the resources and seeing what things we can get behind social economically even more. Yeah.
Absolutely. So I know we're coming up to the top of the hour, but real quick, 30-second, what's kind of like the lightning rod over here? Like, what's silver lining? What can we do? So let's just go around. Just go around what appears on my screen. So Abid.
Look, I mean, I guess, every change happens with the individual. So I think what I would suggest that every single one of us, I don't know how many people we even have on the line here, I think everyone should look around their own community, see if there is a family or disadvantaged, and if we can help somebody, if we can, and I happen to be a bit more biased towards educational causes, right? If you can help somebody, tutor somebody, help them with their high school applications or college applications, see them through, you're not going to be just impacting that person's life, you're going to be impacting lives of everybody else who comes after him or her. So that would be my suggestion to everybody.
Awesome. Pegah, you're next.
If only I could do that better for my own kids. I don't even have time for that these days. But look, I just did a thing, so I'll give some time back to everybody else.
Thanks.
But I totally agree. Start in your community.
Rohini?
So I think, my own view is that, as problem solvers, we have to innovate our way out of these problems. They're very large problems to solve. But as we've spoken about before, we would all have been much worse off if we didn't have the internet and if we didn't really have tech that continued to work during this pandemic. And I do think that, there is a nugget there that we should use tech for good. That's certainly part of my day job, but it's also, what I really believe in.
Awesome. Kashif?
What I'd add is that I think that quite similar to what Pegah said, which is that large employers that are also brand names, they both reflect change that's already happening in society, but they give cues and they actually help accelerate changes of social norms and what's acceptable. And I think we're seeing that in a lot of cases. And when they look for ideas, the senior management levels, the executive levels are increasingly aware that both generationally and ethnically and demographically, they're a little bit disconnected from the next mainstream, and so they look to employees for ideas. So we're seeing that, and there comes an inflection point where those kinds of companies they go from reacting and kind of doing PR to actually accelerating social change. And so, for example, I fully expect that next year or the year after today will be a holiday, and it's a symbolic thing. But it also, there's a lot of people who never heard about it before, and it forces them to examine the history of the country, etc. And so, I do think that there is more willingness to hear from below. There's more understanding that and ultimately companies are commercial. They're not going to do things that are hyper controversial, but they know that the customer profile is changing, and they have an eye to who our customers will be in the future and what their values are and what they care about. And so capitalizing upon that in a smart way and moving change up your organizations and initiatives up your organization can be super effective right now.
Oh, very, very good point. So Dave?
It occurred to me, I guess, the value of mentorship in this period of time. And it dawned on me when I started taking, I teach a number of courses at Stanford, and now we had to take those virtual, and I normally round in the hospital also with a group of people, and that's virtual as well. So I carry people around on my iPhone. They help see patients with me, and I just hold up the phone when I do the exam and that sort of thing. And they even help me translate in Mandarin. And it occurred to me that this generation going through this period of time is going to be at a disadvantage in learning. That's just the reality, that these undergraduates who are applying to medical school, graduate school, trying to figure out what they're going to do next, they are at a disadvantage. They probably will not have the same experiences to put in their application, their resume, talk about things during the interview. And so while mentorship, I feel, has always been important, it's certainly been the thing that's gotten me to where I am. It is now more valuable than ever, because otherwise you end up with a disadvantaged group of individuals who are probably less positioned to help out when things like this happen again. And so that would be what I would encourage people to leverage, is whether we reach out to MIT alums or individuals in our industry or individuals at different alma maters, other schools we went to, they are thirsty for these experiences because they cannot come to campus anymore, and they cannot round in the hospital, and they cannot do internships now. They're thirsty for any replacement for those things. And so maybe that's been leveraged to a large degree already. I'm sure people have thought of it and are probably reaching out, but that's probably something that isn't always on the forefront of our minds, but I think certainly is valuable now.
Yeah, no, absolutely. I think, I just got a call from an MIT junior rising senior yesterday, and, they lost their internship for the summer. And what they've done is she's actually created a marketplace for other students who've lost their summer internships and now seeking projects. So they're not looking for summer jobs just to earn money, but it's actually, they'll volunteer their time. They just want to get the experience, get the networks, get the relationships going, so that next year when recruiting season starts, they're able to get a job, right? So I think those are knock-on effects. So thank you, everyone. Again, we're a little bit over time, but this has been a really rich conversation, and we'll meet again, same time, same place next week.
Great. Looking forward.
Thank you. And thanks for hosting.
Guys.
Thank you.
Bye-bye.